Gold can sit quietly in a narrow price channel for days, barely moving. Then, in minutes, it delivers a violent $50 surge. That intense volatility is driven by macroeconomics. When inflation spikes, or fiat currencies like the US dollar weaken, institutional money rushes into hard assets, causing aggressive price swings. Trying to trade those swings by guessing the direction of the next news headline usually results in buying right at the top, just as the market reverses. To safely trade this asset, you have to stop relying on intuition. You need a strict mathematical filter that separates raw noise from actual market intent. That specific filter is the Bollinger Band. It takes scattered price data and turns it into a breathing, visual map of standard deviation, showing exactly how far the market is stretching. We start with the 20-period simple moving average, the single line tracking the medium-term average price. Next, we add two outer bands plotted 2 standard deviations away to measure volatility. As the market heats up, the bands expand. When volume drops, they contract. That contraction is what traders call the squeeze. The price gets boxed into a tight range, and volatility drops to a recent low. A tight squeeze indicates that energy is building in the market. You don't have to guess the direction. You simply wait in a state of calculated anticipation for the pressure to break. When gold sits locked in deep consolidation, institutional algorithms are quietly accumulating positions, winding the market up like a spring. This shows the exact mechanical trigger. Wait until a candlestick decisively punches through and closes completely outside the top boundary band. To ensure it isn't a fakeout, check the bottom graph. A volume surge alongside the breakout confirms heavy institutional momentum. Waiting for that confirmed close keeps you out of the chop and puts you right on the edge of the surge. Once a confirmed breakout happens, gold can run fast. Many traders cash out early at the first red candle out of fear, missing the actual profit potential. This is a band walk. Price continually hugs the upper boundary, forcing the entire band structure higher. To rejoin the trend, use the middle moving average as dynamic support. Wait for price to touch this middle line, then bounce upward. Mastering the band walk allows you to extract maximum value from a sustained macro trend, instead of settling for a minor short-term scalp. It is crucial to remember that outer bands are not solid walls. Shorting gold purely because it tapped the upper band is a quick way to blow a trading account during a strong run. To protect your capital, you need a secondary tool to measure if the buying pressure is actually exhausting. This is where the Relative Strength Index, or RSI, comes in. This split-screen chart illustrates bearish divergence. Up top, the price hits a new high on the upper band, but down below, the RSI momentum line makes a lower high. That mathematical contradiction signals the trend is dying. For your final layer of confirmation, look at the specific candlestick forming right at that point of divergence. A shooting star shape right on the upper band confirms sellers are officially stepping in. By stacking volatility contraction, momentum divergence, and specific price action, you create a highly defended setup with strict risk parameters. Gold's massive swings are not random. The market breathes in a measurable cycle of contraction, rapid expansion, and eventual exhaustion. Capitalizing on precise mathematical windows requires a platform built for speed. You need ultra-fast execution and zero-pip spreads to ensure your entries trigger instantly. Open a risk-free demo account on NX1 by FXNX today. Practice tracking the squeeze,